Hey everyone, welcome. It is Tuesday, April 30th, 6 a.m., half an hour before the market's going to open. And we're really looking for market direction today. Yesterday, we were looking for it also. We didn't really get it. It's basically flat all day except for a couple of spikes. And today, with a whole bunch of news coming out, a whole bunch of earnings coming out, we're going to get volatility almost assuredly. But whether or not we get directionality, we'll see. We could get some sectors going up, some sectors going down, and overall that balances us out in the markets. It'll be interesting to see if we do get that, because then we'll see what sectors to pay attention to. But overall in the markets, we really want to find that direction. So let's take a look at different levels that we might be looking at, and then whether or not we're going to, or how likely it is that we're going to hit them. But first, we'll look at the futures market and see how we're doing. We're mostly flat. Yeah, mostly flat. This is insignificantly downward. It's down, but not significant. Or actually, it's getting more significant. Let's see here. I do my morning math. So 50, actually, yeah, well, given the size of today, right? I'm sorry, the volatility that we expect today because of the earnings and the reports, this is not huge, but it's starting to get significant. So let's take a look. That's interesting because when I woke up this morning, it was basically flat. So something happened in the last hour or so. And let's take a look. There we go. Okay, so huge sell-off right here in all the major indices. That was right at 5:30, so that is some sort of report or announcement. Let's take a look over here. 5:30 was only the employment cost index. Well, that's not going to do it. Consumer confidence at 7, so we're definitely going to watch half an hour after the market opens. We're going to see what happens after consumer confidence. Definitely, unless I'm trading just like trying to snipe a minute by minute on a day trade, I'm not going to put any capital or make any decisions before 7 o'clock. Is maybe closing stuff, but not definitely not opening any new positions. But 5:30, we're not really seeing anything. This is definitely a report that so it might be earnings. So let's look at the larger cap stocks that had earnings. I'll look at my list of stocks that had earnings. Coca-Cola. So far, not seeing a big reaction to Coca-Cola. Eli Lilly. Nope. McDonald's. Oh, whoa, hang on. Eli Lilly. Here, pre-market. Okay. Eli Lilly to the upside. McDonald's, a huge movement to the downside. PayPal, up. Stryker, not really doing anything. Starbucks, not much. Down. RSG. So we have McDonald's and PayPal, or Lilly, but they kind of balance each other out in terms of direction. That's really interesting. Nothing in earnings, at least in the really large cap ones, that would cause me to think that we'd see a downside move like this. And definitely no report, or at least not on this calendar. Let's take a look over here. Today, April 30th, employment costs. What's it? Well, let's take a look at the report. year over year, no change. Quarter over quarter, it's definitely to the upside. But employment costs just doesn't really move markets, especially when you have an FOMC meeting tomorrow. That's really strange. So at least without a lot more digging, I don't know what happened here. But a lot of times we get caught up with why. Why did this happen? Why did the market move? Why did prices jump? Why did prices go down? And 90+% of the time, the answer is who cares? It doesn't matter. It doesn't matter why. It just matters that it did. So we're not going to worry too much about why this happened. We're just going to say, okay, well, we moved down and we were hugging this 510 level on the S&P 500, which was an important and critical level. And we traded all across it all day yesterday and kept returning to it. And then this morning, it looked like we might open at the same level until 5:30. We suddenly broke down all the way below the 508.5. And at least pre-market, we're still reacting to it. And it looks like we might open around 508. What that means is that we're kind of in more neutral territory when we open. If it had stayed at 510, then we'd be right at resistance and we say, hey, it might break out. We spent all day crisscrossing it yesterday, and today, the longer we stay there, the more likely we're going to break the level. So either to the upside or to the downside. Yesterday, it just felt slightly more like it would be to the upside until the end of the day where we broke way down. But then the recovery was so fast, at least at the end of the day, it was upward momentum. So we would have been looking for a movement upwards and then looking for a resistance at 512. And if it broke that, I don't think these two levels were that big and important. Actually, this 517 to 518 level would have been more relevant. Now that we're down at 508.5, we still have this really important ceiling at 510 to get through before we can see a lot more upside. And if we look at our MA50, it's probably right around there. Our MA50 is at 511. So 510, 511 is still an extremely important level. On the pre-market, that 508 whatever is basically the EMA 20. 508.11 is the EMA 20. So we are sort of at another critical floor, actually. And if we can break through that, then we're probably heading back down to 500. Maybe pausing at 505 in between, 505 to 500. Let me move this one to 500. Okay, this one is more minor. I'm gonna make it thinner. And make this one thinner. And I'll make this one thinner. So it's going to be interesting to watch. If we move downward, then we're moving down basically to 505 and then potentially to 500. And if we move up, we've got to break this 510 ceiling that has been in place for, it's not just been yesterday, it's been the day before. And then if we look back several days, I won't scroll because it looks like it might be several days. 510. Okay, so 510. Okay, yeah, it was a week or a couple weeks back. It was and then a month or so back over here where we were reacting to that level a lot. But in any case, what it shows is that a lot of volume transacted there. And it's a really important level because money keeps changing hands at 510. So if we can finally break 510, what it means is that someone was on the wrong side of a transaction, and we might either see catch-up trading, or is it, oh, I thought it was going to go down from 510, but now it's pretty clear it's going up. Now I have to chase back into the market. Or even more extreme is if they had shorted at 510 and they have to cover their shorts. So 510, extremely important. If we break 510, we're probably going at least over the next few days, all the way up to this 516 to 518 region. And if we break down, then we're going down to 505, maybe 500 region. So let's take a look at what that looks like. 500 region is this MA90 and horizontal line that we have here. So that's pretty likely. And then if we break that, then we're getting our -10 correction. If we go above our 510 level, well, we just broke our MA50. And if we go up with conviction, then there's probably going to be shorts that get squeezed right here. And that's why we say, okay, well, what's the next level? The next level on a day basis would be horizontal level right there. So 517. So everything is matching up on our day chart and our intraday chart. So that's going to be critical to watch. What might give us a clue during the day on what's going to happen is VIX. How high does VIX spike up? So we got that associated spike upwards at 530 and then came back down a little bit, and we're at 15 right now. If we get above 15 and a half, 1540, 1550, then we're almost assuredly going down. So VIX is going to be very important to watch. The S&P 500. This is what I meant when we first started the video, where we're looking for direction. We're looking for we're looking to deviate from this 510, 508 and a half region. We just need to leave it so we can get a clear direction. Either we're going down or we're going up. Right now, and everything that we've talked about over the last few days is that the more likely direction is down, but given all of the earnings at play and given all of the news that's happening, it throws our probabilities off. I shouldn't say it throws our probabilities off. Our probabilities are still the same, but our margin of error becomes much wider. So if I say, normally I say, hey, there's a 70% chance that we're moving down. Well, now it's like 70% chance plus or minus 10 or plus or minus 15%. It just becomes a really wide margin of error because of all of this news and reactivity that we might have due to the news. Okay, so we're going to watch that really carefully. Let's look at bonds real fast because we do have a FOMC meeting. So bonds looks like they're continuing to move upwards, but in the pre-market, they're down. So we're hugging this lower channel line, and we're probably not going to get real direction until we actually hear Powell speak at 11:30 tomorrow. So this is probably going to just chop around for a bit. You can see that if I look over the last couple of weeks, with a couple of exceptions, we're pretty much just chopping sideways, and the range that we're moving in has been pretty much the same. The size of these bars have been mostly the same. So we are just waiting for direction here. We pretty much know, or we're pretty confident that we know what the decision is going to be. We just don't know what they're going to say after the decision. So we're at 99.5% now. So that's really high conviction that we're not going to have a rate change. We just don't know if Powell's going to say, oh, we're going to have a rate cut by the end of the year, or we're still planning on cutting rates. So we just, we need to wait for the data to do whatever. Or, hey, the summer, we're still cutting we're still on course to cut in the summer. If he starts giving a timeline or changing his narrative about how many cuts or when they might cut, or if he keeps saying, oh, it's going to be data driven, but then the data has been floating up, if he tries to explain any of that, then that could start sending markets either up or down, the bond markets either up or down. Bond markets will then bleed into QQQ and anything that's interest rate sensitive, and then that'll affect the rest of the markets. All right. So today, I could go into more stuff, but really it's not that going to be that relevant because it's another wait and see. We really need to see whether or not the we actually get directionality today. Do we actually move down or up today? Which way is it going to move? And that'll help us determine the rest of it. Now, if you get tired of sitting and waiting, which I'm sort of getting tired of sitting and waiting, I don't like having cash just sitting there and doing nothing for too long. And it's been what we've said it last week, and then we said it yesterday, and now I'm saying it again today. We're sitting here waiting for our cash. Actually, sometimes that's the best thing you can do as a money manager or someone who has fiscal responsibility is actually I need to go into protection mode for my cash instead of opportunity mode for my cash. And it's important to identify when that should be if you're going to be a money manager or portfolio manager. So even though at the heart, most money managers like myself are opportunity driven. We have to recognize when it's time to just stop. So maybe I'll just stop myself. I was going to say if you're getting tired of waiting, here's what you can do. But maybe I should just stop myself and say, just wait. Okay, that'd be the more responsible, fiscally responsible thing to do. Just wait. Just see what happens today, and don't be like, oh, the S&P made such a huge move today. It went way down today or went way up. It's okay. If it moves way down, there's still way more down to go. If it moves way up, there's still way more up to go. So you're really not missing out. What you're doing is preserving your capital. So, because what if you get it wrong? If say, hey, I have a higher probability of it going down, let me deploy some capital to the downside, and then I get it wrong and it goes up, then right now I'm starting. I took 2 steps backwards, and I have to try to catch up. Not only do I have to catch up with the upside movement, but I have to make up for that initial loss that I made in my trades. So fiscal responsibility behooves me to just sit and wait and actually see the direction that it goes. So I'll just leave it there before I get myself into trouble. And we'll just get ready, just wait, especially for this consumer confidence report, because that has the power to do what happened at 5:30. So we still don't know what happened at 5:30, but the consumer confidence at 7 o'clock has the power to drive it down once more or undo whatever happened at 5:30. So most likely we're not going to get huge directionality, the directionality that we're looking for, until at least after that consumer confidence report. So definitely sit and wait for the first half hour, and then maybe you can catch some directionality after that if you're day trading, but otherwise just sit and watch. If we get a huge movement in the markets today, we're not going to feel like we missed out, because that's the confirmation that we need in order to confidently put capital to work with high probability and high conviction. So I'll leave it there today and let you guys get ready for the market open. Have a wonderful day, and I'll see you in the aftermarket session.